Trump just lit a 6-month fuse under silver and copper. Not a rumor, not maybe someday. A formal 180-day countdown that opens the door to a minimum price system on critical minerals. First through negotiations, and if that fails, through hard restrictions that can rewrite the price you think is the market. That's what happened. And the real shock won't necessarily be the first candle on the chart. The real shock is what happens when the clock is almost out, and the entire supply chain realizes the rules are about to change overnight. Welcome back to my channel. Now listen carefully, because the headlines will try to distract you with the wrong drama. They'll scream tariffs and trade talks and political theater. Meanwhile, the real weapon is hiding in plain sight. The minimum price mechanism. A price floor. A gate that says, you can sell into this market, but not below this number. That's not paperwork, that's a force field. And once you build a force field around a strategic commodity, everything inside the bubble starts repricing, quietly at first, violently later. Here's why you need to stay to the end. Most people will watch day 1, day 2, day 10, then get bored. They'll think, nothing happened. That's exactly how these moves work. The market doesn't always explode when the policy is announced. The market often explodes when buyers finally accept that the policy will be enforced. And that moment tends to arrive late in the countdown, when it's too expensive to react calmly. So what is this really? It's a national security framing of supply chains. It's a signal that critical minerals aren't going to be treated like normal commodities anymore. They're going to be treated like strategic inputs, like infrastructure, like defense, like the wiring and circuitry of national power. And when governments start speaking that language, the market stops being a free-floating auction and starts becoming a managed pipeline. Silver and copper sit in the blast radius for one simple reason. Copper is the bloodstream of electrification. Grids, transformers, data centers, EVs, military upgrades, factories, copper is everywhere. And there is no copper-free transition that works at scale. Silver is different. Silver is the quiet, multi-purpose metal. It sits at the intersection of industrial function and monetary psychology. It's an input, a hedge, and a signal. That's why silver reacts like a nervous system whenever governments touch the supply chain. Now, the first thing you must understand is the timeline trick. There are no immediate tariffs in the front page framing. Instead, you get a 180-day clock. Negotiate first, coordinate with allies, try to reach alignment. And if those talks fail, or if they become political embarrassment, there's a clean legal path toward restrictions and enforced pricing. That's not a soft threat. That's a structured threat. That's the difference. A random tariff is a punch. A price floor system is a new skeleton. And skeletons don't disappear when the news cycle moves on. Let me translate price floors into real-world behavior. A tariff says, you can import it, but it costs more. A price floor says, you can import it only if the declared price is above the floor. If the cheapest foreign supply tries to enter below the threshold, it gets blocked, reclassified, penalized, or rejected. So what happens next? The lowest price supply vanishes, not because the metal evaporated, but because the rules changed. And when the lowest price supply vanishes, everyone competes for the next cheapest bucket. That's how you lift an entire curve without adding a single new buyer. You just remove the bottom rung of the ladder and force everyone to climb. But here's the part the headlines won't say out loud. Price floors require enforcement systems, reference pricing methods, documentation rules, audit trails, anti-circumvention language, so companies can't relabel the product, route it through a third country, or change a code and sneak it in as something else. That's why a floor is not one number. It's a machine. And once the machine exists, it creates winners and losers. Winners are inside the trusted network, compliant, allied, politically aligned, strategically valuable. Losers are outside, not necessarily banned, but squeezed, limited, taxed, delayed, or forced into different markets. Now I want you to notice something chilling. Even if negotiations succeed, prices can still rise. Because success can mean a coordinated minimum acceptable pricing framework. It can mean anti-dumping commitments without calling them that. It can mean stockpiling agreements. It can mean voluntary limits that behave like restrictions. So don't assume a deal equals cheaper metal. A deal can legitimize the floor. Now we're going to run this like a chessboard, not like a headline. There are three broad outcomes, and the market can trade all three at different times during the countdown. Outcome 1. Smooth agreement. Allies coordinate. Minimum pricing is quietly accepted. Supply continues, but the floor lifts the baseline. Volatility drops, price stability rises, and everyone pretends this was the reasonable solution. Outcome 2. Messy agreement. Talks drag, leaks and rumors fly, headlines flip daily, markets whip. At the last moment, a patchwork deal appears with loopholes and carve-outs. Price swings because nobody trusts the details. Outcome 3. Breakdown. Negotiations fail. The hard tools come out. Minimum import price enforcement and national security restrictions hit the pipeline. Retaliation threats appear. Buyers panic secure supply. The complex reprices fast. Now here's the uncomfortable truth. Even if you personally believe outcome 1 is most likely, the market can still trade outcome 3 for weeks, because risk gets priced before certainty arrives. That's why this isn't a one-day trade, it's a countdown trade. And countdown trades are psychological warfare. Month 1, confusion, hot takes, people underestimating the story. Months 2 and 3, progress narratives, optimism, everyone relaxes. Months 4 and 5, pressure, deadlines, threats, last-minute bargaining. Month 6, the public wakes up, right when institutions have already positioned. If you've watched markets long enough, you know the pattern. The biggest moves often happen when most people are bored. Now let's talk about the real cliffhanger. The official deadline might not matter as much as the procurement deadline, because the real question is not what happens on day 180. The real question is, when do large buyers decide they can't risk waiting? Manufacturers don't buy based on vibes. They buy based on continuity. A factory can't stop. A grid upgrade can't pause. A defense contract can't shrug. So what happens when procurement teams look at that countdown and say, if the system changes, we could face supply interruption or a price jump, and I don't want to be the person explaining a shutdown. They start locking supply. They sign long-term offtake agreements. They build inventory. They front-run the government. And that's where price moves mysteriously, even when the news sounds quiet. This is why the first move in price may be the smallest move, because the early phase is positioning. The late phase is panic. Now let's address what you might see on your screen and why it can feel backwards. You can get aggressive selling even on structurally bullish news. Why? Positioning. If too many traders are already leaning bullish, news becomes an excuse to take profit, reduce leverage, and rebalance. The story can be bullish while the tape is ugly. Don't get hypnotized by the first candle. The first candle is often a liquidation event, not a truth event. The truth reveals itself in what happens after the market has time to think. Now here's where it gets serious. Because this isn't only about raw metal. The policy language targets processed materials. Processed. That word matters more than most people realize, because the bottleneck is often not metal in the ground. The bottleneck is refining, processing, converting, and delivering in the form industry actually needs. If a country decides we're too dependent, the next step is predictable. Investment into domestic processing. Investment into allied processing. Financing support. Permitting acceleration. Strategic partnerships. And when that starts, the market doesn't just reprice spot metal, it reprices the entire supply chain. Which means the biggest upside for some investors won't be a bar of metal. It will be the companies and assets that can deliver real supply under the new rules. But this is also where people get wrecked, because not every miner is a real business. Some have reserves and permits, some have a map and a dream, some can finance responsibly, some dilute shareholders into dust, some can build, some can only hype. So do not treat mining exposure like a lottery ticket. If you touch it, treat it like business analysis. Jurisdiction, permitting, balance sheet, path to production, processing access, execution history. Because when policy money shows up, the best operators get stronger, and the worst operators get louder. Loud doesn't pay you. Execution pays you. Now pause and answer this in the comments because I want to see how you're reading the board. Which outcome do you think we get at the end of the 180 days? Calm deal, messy deal, or breakdown? And second question, if governments start enforcing price floors for strategic materials, Is that a sign of strength or a sign that the free market era is shrinking? Drop your take. I read the comments more than you think. Now, back to the mechanism, because you need to see the trap inside the trap. People hear minimum import price, and they imagine a clean, simple floor. But the real effect is a behavioral cascade. If you're an importer, you don't wait for the last minute. You start adjusting contracts now. If you're an exporter, you start choosing preferred buyers now. If you're a processor, you start renegotiating margins now. If you're a manufacturer, you start stockpiling now. And if you're a speculator, you start front-running all of them. That's how the entire market shifts before the law even bites. Now let me show you why day 179 can be more dangerous than day 1. Early in the countdown, everyone thinks, we have time, it'll get resolved. Late in the countdown, buyers realize, we have no time, we need supply regardless. That's when rationality flips. That's when price becomes secondary to certainty. And when certainty becomes the priority, you get the one behavior that breaks charts: chasing. Now, the public will look at that chase and call it manipulation or panic or a bubble. But from the supply chain perspective, it's survival. Now, zoom out one more layer. This is happening in a world where every major economy wants the same thing: security without sacrifice. And the easiest way to buy security is to control inputs. Critical minerals are leverage. If you control the inputs, you control production. If you control production, you control bargaining power. That's why this policy framing isn't just trade, it's strategic alignment. And strategic alignment creates new choke points. Now here's the second cliffhanger people miss. Once a government normalizes intervening in strategic commodities, the list expands. It never shrinks. Today it's a basket: batteries, grids, electronics, defense. Tomorrow it's next-generation manufacturing. Then it's infrastructure resilience. Then it's emergency allocation. Temporary programs have a habit of becoming permanent institutions. So even if you don't care about metals, you should care about what this signals. State involvement is moving upstream. Now I want to be crystal clear about something. This is not a call to panic buy. This is not a to the moon scream. This is a map. Because the danger for most people is not being wrong. It's being late. Late is where premiums live. Late is where volatility punishes you. Late is where you make emotional decisions. So the game is to understand the sequence early, build a plan, and stop letting headlines toss you around like a leaf in a storm. Now let's talk about what you should watch during the countdown. Practical signals, not vibes. Watch for language about joint stockpiles. Watch for trusted supply frameworks. Watch for funding programs, loan guarantees, grants, strategic financing. Watch for permitting acceleration and fast-track approvals. Watch for defense procurement language shifting towards secure sourcing. Watch for infrastructure contracts specifying preferred origin. Watch for export controls or supply policy changes from other countries. And above all, watch for long-term offtake agreements. Because offtakes are where the future gets priced. Offtakes are when the supply chain stops debating and starts committing. And once commitments start stacking, the market has to reprice. Now let's address the biggest confusion point I see. People think price floor means the government is trying to raise prices for investors. No. The government is trying to stabilize access for industry and reduce dependence. But the irony is brutal. You often need higher guaranteed pricing to make domestic and allied production viable. If producers can't make money, they don't invest. If they don't invest, you stay dependent. So the policy path that is designed to reduce vulnerability can still push the baseline price higher, not because the goal is higher prices, but because the goal is supply security, and security has a cost. Now let's separate two worlds. World 1, physical metal ownership. That's about having an asset that isn't a promise. It doesn't depend on a CEO, a quarterly report, a permit, or a political favor. It's about counterparty risk. World 2, operational leverage via producers and processors. That's about upside, but also about execution risk, legal risk, and dilution risk. Which is better? It depends on your purpose. Safety and simplicity lean toward physical. Upside and leverage lean toward operators. Balance can be both. But don't confuse them. Because when policy shifts, physical can tighten, while operators can become strategically useful. And strategically useful is a strange kind of bullish. It can mean support. It can also mean scrutiny. It can mean subsidies. It can also mean new rules. So the playbook isn't buy and forget. The playbook is buy and stay awake. Now here's the part that will irritate people, but it's true. The market will try to sedate you with optimism headlines. You will hear, talks are going well. You will hear, a deal is close. You will hear, the worst case is unlikely. And maybe that's true. But even if it's true, the process of negotiating can still pull future demand into the present, because buyers hate uncertainty. So prices can rise on good news and rise on bad news. Different reasons, same direction. And that's why this story is bigger than a headline. It's not about one policy. It's about the willingness to build a pricing framework around strategic inputs. Now, I'm going to recap the event in plain English, and I want you to lock it into memory. A national security finding says, we're too dependent on foreign processed critical minerals. The response creates a 180-day window to negotiate import adjustments and coordinate with allies. The stated goal includes minimum pricing frameworks, price floors. If negotiations fail, stronger tools can be used, including enforced minimum import price systems and national security restrictions. Silver and copper sit inside that net. That's the sequence. And the reason this matters is because markets front-run sequences. They don't wait for the stamp. They move when they smell the stamp. Now, two quick things before we close. First, if you got value from this breakdown, subscribe to my channel. Short and simple. It tells the algorithm you want more of this kind of analysis, not recycled noise. Second, I want one more comment from you and make it specific. Do you think the real shock hits early in the countdown or late near the finish line? And if you had to choose one signal to watch, stockpiles, offtake deals, or enforcement language, which one do you think moves the market first? Because here's the final punchline. A 180-day timer isn't just a deadline. It's a psychological weapon. It tells allies, decide. It tells producers, prepare. It tells buyers, secure. It tells speculators, front run. And it tells the public, you'll understand it right after it's priced in. So don't wait for day 180 to start paying attention. Day 180 is when the crowd shows up. And the crowd always pays the premium.